Hey everyone, how you doing today? Topic number 3 with Jonathan is actually what I referenced on January 1st. On January 1st, I said if I had a gun to my head, the only metric or only variable I would track is the 10-year Treasury. I think at the time it was at 0.91. It is now, as of this morning, hit where's my notes? 1.453. It doesn't sound like a lot, but folks, that's a 50% jump and it is trending in the wrong direction. So Jonathan, do you follow the 10-year Treasury at all? Have you seen this jump here this week?
I did. I noticed that this morning when I was looking at the unemployment data that was scrolling across my screen that the 10-year was up to. I think at the moment that I looked at it, it was 1.46.
Okay.
So
yeah.
I mean, this is the trend is in the wrong direction. Well, I mean, what does wrong direction mean? Like, it depends on wrong for who.
Yeah,
right?
That's fair.
Right.
Wrong for you. Yeah.
Wrong for anybody who is dependent on it being lower than that. Let's put it that way, right?
Well, it's again, we're a real estate channel, so again, so another guy that I speak with on Wednesdays and is a mortgage broker. He's let me know that on what was it, Tuesday of last week, rates went up a quarter point. They reset 3 times in one day, which is not normal, and I'm sure they've gone up more since.
Yeah. So let's talk about sort of why that matters,
okay.
Right?
Yep.
So the mortgage rate that you pay is a factor of the Treasury bill and then the spread that the banks build on top of it, because they're basically buying the Treasury. Essentially, they're borrowing money at the Treasury rate, and then they're lending it to you at that plus the spread, and the spread is their profit. And the banks will eat some. They have the flexibility to kind of, they change the spreads, right? So the spreads expand and contract also, right? And so the banks have the ability to kind of, if there's some little fluctuation, they kind of like will eat some spread sometimes and like make a little less money. Some cases they don't really care that much because they're going to sell the loan off to somebody else anyway, right? So, and there are these investors out there who were very happy to get 1%, like effectively, because for whatever reason, the insurance companies, whoever it is, right? So, as long as it's certain, and that's what they care about, is the certainty of it,
right?
So but the issue is when you have like these quick spikes, and if it's a big spike, then the banks can't eat the spread. They've got to raise the interest rate, and when they raise the interest rate, the end interest rate, the function of those two things, so the addition, the addition of those two things, it affects how much proceeds you can get on the loan, right? So if you're in the middle of a transaction, right, and you've underwritten it based on interest rate of X, and the bank has told you, hey, we're going to give you 75% loan to purchase on this thing that you're buying at X interest rate. Well, when that X interest rate goes up, the bank comes to you and says, hey, we can no longer give you as much money, right, because it doesn't meet the, like you're no longer making your debt service coverage payment, like whatever. They've got all these different things that they're calculating to figure out how much money they can give you. So the interest rate, if you're in the middle of a transaction, a spike is really, really bad, right, for you. And also, if you obviously own real estate and you're looking to sell at some point, if interest rates are rising, that's going to affect cap rates, because it's going to limit the amount of money that the buyers can borrow.
Yep.
It's going to limit the amount of money they can pay you, right? And so that's going to force the cap rate to go up. So if interest rates are moving around a little bit, it doesn't really affect things that much, as I said, because the banks will absorb it in the spread. Yeah. You can finagle things a little bit, but if you start getting interest rate spikes like 50 basis points or a full point, if the whole market has set itself around like an all-in interest rate of 3.5% or lower, which a lot of people have been getting, and that's been driving pricing really high. And suddenly now the interest rates are 4.5%, right? They're still really low by historical standards, and cause high valuations as a result. However, as compared to where it was, the year before, you've lost money on paper because your asset is less valuable unless you've had enough NOI growth to offset the cap rate decompression.
Right.
Again, as we mentioned before, the issue really is like if you've got to refinance and there's enough of a sort of short enough term and enough of a delta in the interest rate rise, then that's an issue. But another issue for real estate investors is if interest rates rise enough to cause skittishness in the stock market,
yes,
and there's a stock market sell-off because of it,
yep,
then what happens is your investors now don't have as much money
exactly
to invest with you, or they're feeling scared because they've just lost money in the stock market and their appetite for investing diminishes.
Yeah, I think there's a couple of things there I want to hit on. So first off, folks, if you don't think that's possible, go back to February and March where hard money and private money essentially dried up for about 8 weeks, right? Yeah. Remember Jonathan and I talking about deals in escrow being pulled because the money vanished. So the stock market, I think that drop was 31%. I remember kind of peak to trough before it started coming back. The other thing we got to talk about with real estate is this has all been kind of multifamily. But think about single family, right? What is one of the hot parts of the market? It's been single family. And I was talking with the broker last week, and, a rise of a quarter point is enough for some people to go from getting a yes answer to a no answer from a bank. And the more that goes, right? So that's going to impact buyers, right? So, if you have 100 buyers qualified today, then it'll be 95, then it'll be 90, then it'll be 85. It just kind of works its way down. The other thing's important I talk about in my book is affordability, right? Affordability eventually gets stretched. And part of that equation is the payment. And the biggest part of the payment variability is the interest rate. And, the price of a property doesn't have to go up for it to become less affordable, right? The interest rate goes up and that's a problem. So, Fresno today's a 48. Prices don't move an inch. If interest rates go up a point, affordability will go to 34 or 32 or something, right? So folks, you got to watch this whole dichotomy because right now, single family homes are raging higher of, 10% values, 14% median because you have a different mix of first time and luxury. Probably another hot quarter or two coming up given low supplies. But if we have that going on into a rising interest rate environment, you will eventually eliminate buyers. And then we got a problem.
Let me ask you this question.
Sure.
What is in terms of home prices, what is the more important variable? Is it the lack of inventory or is it the presence of buyers, right? Because the inventory is so low.
Yeah, today it is absolutely inventory without question, right? When you have 3 weeks of supply, 3 weeks, and if you strip out the $1 million homes in my market, it's more like 2.5 weeks.
Wow.
That's unheard of. That's almost unfathomable, right? Low inventory. So it's definitely a low inventory, but again, I'm just nervous. It's sort of like, I see it potentially, this is a risk. I see it like your thumb on a champagne bottle, right? It's being shooken. Right now, the inventory is kind of just the ability for a price explosion is there. But if you have that going on into a 50% jump in interest rates, right? You go from 2.5 to 3 3/4. That's back to, that could be challenging. That's my fear, I guess.
As a single family investor, is if you have rising home prices, is that bad for you because rents are not keeping up so you don't make as much money, or is it good for you because it means more people are renting because they can't afford to buy?
As long as you are doing what I say, which is getting cheap 30-year debt, net is positive, right? You may have a short-term blip because values go up first, rents lag. Rents usually are 9 to 12 months behind. But without question, the best part of my portfolio the last 18 months has been homes. My homes at transition, right? Somebody leaves, somebody comes in. Rents are up 25% in that case. Wow. And consistently, right? They've gone from 1,200 to 1,500, from 1,450 to 1,700. At transitions. So yeah, single family home is the place to be in my market. Apartments for me are flat. I haven't lowered rents yet. I haven't had to do deposits, but rents are flat in apartments, right? Nobody wants to live side by side if they have the choice.
Right.
So,
And in terms of the single family rents, like how much are you typically raising rents year to year for an existing tenant?
well,
Not,
so
not a move out.
I would say average is 5%, 5 to 7 for
And
a
then,
house.
but a big jump when you have somebody move out, you have a new tenant come in.
Well, this again, let's be clear. That is a this year phenomenon. I've been doing this 20 years with homes. I've never seen my move out. I was happy with $50, right?
Yeah.
If I got 100 because of some oddity, great. But I mean, yes. I mean, I remember one house went up $400, just a little 2-bedroom, 1.5 bath, $400 rise. Now I did pretty it up, blah, blah, blah. But man, that's significant.
Yeah. That's substantial.
So, yeah. So I think the rising 10-year is telling us, I think what the rising 10-year is telling us is, you remember the taper tantrum from, I think it was 2013?
No, 2018.
Or is it 18?
It was 18. I was actually trying to sell property in the middle of it. And that was, it was tough because the interest rates were going up and everybody freaked out. Right. So
I think we're getting really close to that. I think we're going to get over 1.5 by the end of March, which I think is a psychological number. I mean, dude, we're close to that now. And we could be approaching 2% by the end of the year. And I think that's enough of a jump to I think like you said earlier, I think that you get to 2%, that impacts the stock market. That's what I think.
Yeah. Well, I mean, listen, on a sort of larger level, right? The economy has become addicted to cheap debt.
No kidding.
Right?
Yes.
And
No question.
And, I can remember 30 years ago, well, I guess 20, 25 years ago, my dad, being very excited about being able to refinance his mortgage at 6%. Right. And it, like since then, it's just been a downward trend.
Yeah.
And we have, companies that shouldn't exist that are existing because they can borrow cheaply. And, I think rising interest rates would be painful for sure in the short term, but like long term, we need to have higher interest rates. And we need to, also get control of the the budget deficit, and we need to kind of like reset things. And because the debt is just a drag. I mean, we would have much higher economic growth if we weren't spending so much money servicing the debt.
Yep.
Right. So
I agree.
And so.
Yep. Very cool, Jonathan. This has been a lot of fun this week. You have a wonderful week. All right.
You too, Michael.
Thank you.